Every piece of financial content you have ever consumed is running the exact same script. Make your money work for you. Compound interest is the eighth wonder of the world. Never leave capital idle. It sounds sophisticated. It sounds logical. It has also become one of the most effective psychological traps in modern investing, keeping millions of investors permanently exposed to market risk. The financial services industry is built largely around a concept called the velocity of capital. Brokers, asset managers, and institutional platforms generally make more money when capital is actively invested and moving through the financial system. Every time money is deployed, reallocated, or traded, fees, commissions, spreads, or management revenue are often generated. The entire ecosystem is therefore incentivized to treat idle cash as something that should be put to work by purchasing an asset. As a result, the modern retail investor has been conditioned to look at a liquid bank balance with a sense of pure guilt. You see inflation gradually eroding your purchasing power over time, panic, and throw that liquidity directly into overvalued index funds, real estate, or equities just to stay ahead. By doing this, you are willingly surrendering the most powerful predatory advantage an individual can possess in a capitalist economy: structural patience. When you strip away the academic jargon, the global financial system behaves exactly like a high-stakes game of musical chairs, but with one critical distinction. The music often stops when leverage throughout the system reaches its peak. The institutions pushing you to stay fully invested are often the very same institutions that maintain enormous positions in short-term government debt, cash equivalents, and overnight liquidity facilities. They are not necessarily doing this because they fear the market. They are doing it because they understand a brutal structural law that the retail public often ignores. In a credit-driven economy, major market declines are frequently accelerated not because businesses suddenly become worthless, but because someone, somewhere, is forced to liquidate their holdings to satisfy a debt obligation they cannot meet. And when forced liquidations begin, asset prices can temporarily decouple from underlying value. That is the moment the game changes. To understand how cash transforms from a passive shield into a predatory instrument, you have to stop looking at the economy through the lens of retail personal finance. You have to look at it through the lens of systemic structural failure. Nearly every major financial crisis in modern history has been amplified by a single predictable mechanism: the maturity wall. When major corporations, investment funds, and commercial property owners buy assets, they often don't use cash alone. They rely heavily on debt financing, frequently structured on multi-year terms. The financial system operates on the assumption that when these loans mature, many borrowers will refinance rather than repay the entire principal outright. But right now, the music has slowed. Hundreds of billions of dollars in corporate and commercial real estate debt, much of it originated during years of historically low interest rates, are reaching maturity. Many borrowers now face a dramatically different financing environment, where refinancing costs are substantially higher than when those loans were first issued. Suddenly, a cash flow positive asset can become mathematically difficult to sustain. The numbers flip from black to deep red almost overnight. This is where the trap snaps shut. When a multi-million-dollar fund or asset holder realizes they cannot afford the new interest payments, they look to the banking sector for a lifeline. But many regional banks are fighting their own invisible war. They are facing significant liquidity pressure as deposits have flowed into higher-yielding alternatives such as money market funds and short-term government securities. With tighter liquidity, many banks become far more selective about extending new credit or refinancing existing loans. The era of extend and pretend becomes much harder to sustain. This creates a highly concentrated phenomenon known as a forced liquidation cycle. When a fund faces a margin call or a looming debt maturity it cannot refinance, it enters a state of structural panic. They don't necessarily sell their worst assets first, because distressed assets are often the hardest to sell during a squeeze. To raise cash quickly, they frequently sell their highest quality, most liquid assets instead. They are forced to sell what they love, not what they want to lose. Because they have limited negotiating power and an absolute deadline, they cannot wait indefinitely for a better market. Their structural urgency becomes the cash holder's ultimate discount. While the fully invested retail crowd is busy watching their paper net worth fluctuate on a screen, unable or unwilling to sell without locking in painful losses, the individual sitting on pure, untamed liquidity steps onto the battlefield. You aren't trying to outsmart the market. You are simply showing up with oxygen to a room full of people who are suffocating. When the system forces an asset holder to liquidate, the entire concept of market value begins to break down. The price of an asset is no longer determined primarily by its long-term potential or its intrinsic worth. It is increasingly determined by the speed of execution. This is where the retail public completely miscalculates the math of opportunity cost. They are taught that leaving money in liquid instruments while inflation erodes purchasing power is a losing game. What they fail to realize is that the option value of cash is nonlinear. You might give up 5 or 6% in nominal gains for 2 consecutive years by refusing to enter an overextended market, but when a severe liquidity crunch hits, that patience can unlock an asymmetric opportunity capable of outweighing years of passive index fund compounding. Consider the reality of all-cash transactions. In high-stakes acquisitions, whether it is distressed real estate, private corporate debt, or structured business buyouts, the buyer who requires financing can become a significant liability to the seller. A financed offer often means dealing with commercial lenders, waiting for underwriting approvals, risking appraisal issues, and hoping the credit markets remain stable before closing. To a fund facing an immediate debt maturity or a margin call, a financed offer may simply take too long. They don't have weeks. They may only have days or even hours. When you step into that vacuum with pure cash, you are not just a buyer, you are a liquidity provider, and you are in a position to negotiate aggressively. That advantage often manifests as a meaningful discount on the purchase price. In many private market transactions, an all-cash buyer can negotiate substantial discounts because they can close quickly and eliminate financing uncertainty. That is not merely a theoretical benefit. It can represent an immediate improvement in the economics of an investment before any future appreciation occurs. You are capturing value created by the seller's urgency rather than relying solely on future market performance. To build this level of asymmetric leverage, you must entirely restructure your personal cash mechanics. You have to divorce yourself from the emotional framework of the typical consumer. The average person treats their bank account like a singular, chaotic pool of capital. Money flows in, bills flow out, and whatever remains is left to sit until anxiety or guilt forces them to dump it into a retail brokerage account. To execute the predatory cash playbook, you must split your liquidity into 3 hard, uncompromising silos, each operating on an entirely different time horizon and strategic mandate. The first silo is your baseline operational liquidity. This is your survival floor. It is calculated strictly on your minimum viable budget, the absolute bare minimum capital required to keep your lights on, your operations running, and your baseline secure if every single external source of revenue instantly vanished. This money is never touched, never calculated as part of your investment capital, and never exposed to market risk. Its sole purpose is psychological stabilization. It exists so that when the world around you enters a state of panic, your brain remains clear, rational, and completely detached from short-term fear. The second silo is your career and operational leverage fund. This is 12 to 24 months of strategic capital held deliberately outside the market. Its purpose is not safety, it is agency. In a down cycle, one of the biggest threats to your wealth-building potential isn't just a falling stock portfolio, it is the loss of your primary income stream or the strangulation of your business's cash flow. When you lack this layer, you are operating from a posture of pure desperation. You are forced to accept bad contracts, stay in toxic professional partnerships, and take lateral dead-end steps just to maintain cash flow. When you fund this silo, you buy the power to say no. You buy the ability to reject lowball offers, walk away from bad terms, and fund a protracted strategic pivot while your competitors are forced to downsize or declare bankruptcy. The compounding effect of making high-level career and business decisions from a position of strength rather than economic desperation is an often overlooked factor separating those who build enduring businesses from those who remain financially constrained. The third and final silo is your offensive capital pool. This is pure, unadulterated dry powder. This money does not exist to earn a modest yield in a savings account, and it is not placeholder money waiting for your next monthly index fund contribution. It is patient capital. It is earmarked specifically for periods of severe market stress. Holding offensive capital requires a psychological fortitude that most investors do not possess. It means watching public markets climb to record highs month after month, enduring the mocking commentary of the fully deployed retail crowd, and willingly absorbing the short-term drag of inflation while you sit on the sidelines. But you are not on the sidelines. You are an economic predator waiting at a watering hole. You understand that prices do not announce their declines. They can collapse violently without warning, and the window to capture assets at panic pricing is often incredibly brief. When the credit cycle turns, forced liquidations can trigger cascading margin calls, widespread selling, and institutional panic. Liquidity evaporates from parts of the financial system, and asset prices may fall well below what many investors believe to be their fundamental value. That is your entry point. While the fully invested public is locked in a state of financial paralysis, unable to buy because their capital is already committed, you deploy your offensive pool into high-quality distressed assets at extraordinary discounts. You are buying when everyone else is being forced to sell. The global financial system creates powerful incentives to keep capital moving through products, managers, platforms, and fees. It rewards participation, leverage, and continuous deployment of capital. The ultimate rebellion and the ultimate path to structural wealth is to stop playing that game on everyone else's terms. Restructure your capital, separate your liquidity, build your dry powder, because when the music finally stops and the leverage unwinds, the crowd will look for an exit, and you will be the one holding the keys.